Hi everyone, welcome to this live show again. Once again, here we are to review the weekly events and the weekly levels for mayors to see what we can get out of this market, right? Anyway, let me start by sharing the macroeconomic calendar. Okay, there we have it. There it is. Let me scroll a bit down. Let me start by saying that there have been three big events over the last 24 hours that worth mention. The first one has been the Reserve Bank of New Zealand, which has opened doors for further rate cuts. The Reserve Bank of Australia minutes, which were pretty dovish and expressing concern about local growth, right? Both boosting the greenback during the Asian session, right? The third main event that took already place today, it has been European data. We have both reading coming from UK and Germany. The fact is that we have pretty nice inflation readings coming from United Kingdom earlier today, right? But these are June numbers. That means that these numbers are pre-Brexit. And the word pre-Brexit is not the same word as the post-Brexit word, meaning the market has paid little or none attention to this data. And let's we get numbers out of the United Kingdom coming with information updated from post June 24. Data will hardly have an effect on the pound, okay, guys? The other thing that it's pretty shocking is the confidence survey, the sales survey from Germany, which indeed it's showing us a post-Brexit reading, sentiment, confidence plummet all across the euro area and Germany, right, into negative territory because particularly of the uncertainty, the fact that the United Kingdom is leaving the euro area is generating. I was reading earlier today that after the Brexit, Governor Carney said he will resign in October. And in less than a month after Brexit, we already have him out and a new Brexit cabinet formed by Theresa May as the new UK minister, right? UK Prime Minister, sorry. And well, of course, she had his team, David Davis, Ryan Johnson, and so. But anyway, they're still reluctant to trigger the Article 50 of the Lisbon Treaty. I was reading earlier today that some lawmakers in the UK are talking about maybe that by the end of the year, maybe December, right? Despite the people has voted, despite the new cabinet has been formed much earlier than initially estimated, the UK is in no rush to leave the euro area. And I guess what we are seeing in the market, lack of action around the euro, is due to the fact that the market is waiting for the European reaction to these decisions in the UK, right? How Draghi is assessing the Brexit, how the European Commission will deal with this, and the fact that the UK is in no rush because they want them to leave us up, guys. So pretty much, I do believe that we are not going to get much information this week or much clarity of this issue. But unless something comes out from the euro area authorities in regards of how they will act from now on with the UK, the euro will continue in a limbo, right? Anyway, back to the calendar. I'm sorry for putting that in the middle. We have no much data coming from the US later today. In fact, so far this week, the US calendar has been quite empty and it will remain pretty much so for the rest of the week. I do believe that on Wednesday, the June employment levels in the UK will have the same effect as what we were discussing a few ago on inflation. We're talking about June and May figures, right? These are pre-Brexit numbers and are quite irrelevant in the ongoing scenario for the pound. But keep in mind that employment is employment and always a positive number can push the price higher and a bad number can put the pound under further pressure. Furthermore, I do believe that the dominant trend in the pound is bearish. Sorry, bears are in control of the pound, which means that if data is in line with market sentiment, the reaction will probably be more interesting than if the numbers, macroeconomic numbers, are contrarian to the market sentiment, right? But anyway, back jumping down to Thursday, the main event, of course, will be the ECB interest rate decision. We also have retail sales in the UK. Goes the same for what I have just said for employment and what I did before on inflation, right? If numbers are in line and market expectations were above, we were going to see little reaction. If they're extremely negative, the pound will be more sensitive to those numbers. Anyway, back to the ECB, which is probably one of the main events. I do believe the market is putting too much expectations on this meeting. The ECB is still implementing their latest decisions, their latest announcement, the full bazooka launch earlier this year. So we are not expecting them to take any new measure, right? They are not going to cut rates. They're not going to extend easing. The most we can see is Draghi talking about the consequence of Brexit, or maybe even being more dovish, talking about expanding quantitative easing. I don't know. I don't believe so. I don't believe he would do anything. I do believe that we are going to have a non-event this week with the ECB, right? Not really much more action, which could leave the euro in this limited range we are seeing since the end of June. Uh, Following that report, we have some minor figures in the US, initial and continued jobless claims, existing houses sales and existing home sales, sorry, and the lead indicators. So, as I said, not much relevant data coming from the US this week. And on Friday, I do believe that we are going to get a much more interesting price action from the euro than on Thursday with the ECB, because we have all the preliminary July manufacturing services and composite figures of market PMIs from most major economies, the euro region, and as an exception, right, as an exception, we will have preliminary figures for the UK. This is not something that happens every month. This is something market has prepared especially due to the Brexit. So beware of these numbers. If we're talking about July for the composite services and manufacturing PMIs, I could expect big plummets here, right? Big falls because of loss of confidence after Brexit, right? Among producers and manufacturers. So this could bring some more action to the euro than the ECB, as I was saying. And of course, these readings from the UK will take center stage. They are already expected below 50. 50 is the line that divides contraction from expansion in the economy. But I go there to say that we are going to see much worse numbers than these two we're expecting in here, right? Mostly, as I would say, because the decrease in confidence the market has in the local economy, in European general economy, after the latest political developments, right? Anyway, later on the day, we have Canada inflation data expected to tick modestly lower, which should not come as a surprise given that that's what happened with US inflation, right? We have a mix of numbers, not as positive as we would like to hear, but mostly in line with previous and with market expectations. To close the week, we have the preliminary July reading for the manufacturing sector in the US, expected slightly positive. I do believe that we need a really shocking increase in the year to push the dollar higher. Anyway, and back to dollar. The fact is that the greenback is trading pretty strong across the board and against most of its major rivals, particularly because data has been supportive of growing the US. We have had fears of a global economic slowdown by the end of 2015, triggered by China. The slowdown in economic readings extended into the first quarter, but what we are seeing this 2 months almost is that US data has picked up during the second quarter, right? We are seeing more stronger numbers, inflation, increase of prices in manufacturing, in factory orders, in employment also. After the May terrible employment reading, we have the June outstanding number, right? So in general, what's supporting the greenback right now is not risk aversion or its safe haven condition, but the fact that American data is coming strong, and that is reviving hopes that the Fed may raise rates. I don't know, maybe next year, right? Because after Brexit and all of the easing going on through the world, uh, expectations have turned to late 2017, sorry, or even early 2019. But now the fact that US data is positive, right, is reviving hopes that the Fed may act. I'm not sure. I wouldn't dare to say this year, but at least at the beginning of the next one, okay? Anyway, let's take a look at levels and charts and so on. And let's start with our friend Euro. I have drawn these lines, right, with the 1090 level being the highest after Brexit and having been tested once in the immediate week, but with the price standing below it a couple after 2 weeks and now breaking below this ascendant trend line. Still, ever since the Brexit, the pair has been trading pretty much in between 110 and that 1190, with the range shrinking as the time goes by and with no clear direction strength, right? I know we're breaking through this short ascendant trend line, but I would like to see the pair really breaking through 110, the psychological level, to talk about further declines, short and longer term. In the shorter term, I do believe that 960 and 910, of course, that low, are the levels to watch and the probable bearish targets. And in the longer run, let me take you to the weekly chart. We have a strong support in the 800, 840 region. So let's put a line there. I will turn it to daily and make it smaller, right? And there you have how many times the pair or the price has stalled around that 800, 840 region for the past few months. So I do believe that it's a probable bearish target, right? But I'm honestly not seeing the pair breaking through that 800, 840 region anytime soon, right? Unless, of course, we have, I don't know, the Fed rising rates by surprise next September, something like that, guys. But honestly, that's sort of a line in the sand for me, a probable bearish target. I'm not seeing much scope for a break below it. Anyway, I'm back to the short term. The pair has been starting around 1080 this week, so that comes as the immediate resistance, followed by 1120, 1130 region, right? And of course, above this 1130, that 1190 is the key. As long as below that level, I don't see any chance of a real recovery in the common currency. Only above that level we may talk about a stronger euro and maybe target 1270, 1310. That's a probable bullish target I can see on a break above this line, right? Still seems that we are not getting anywhere there because that's quite bearish. And for the pound, the level I'm following really strongly is this 3320 region, right? Because it's the 23.6% retracement of a post-Brexit plumb. And if you take a look at the chart, well, you can see it, right? The price stalled there plenty of times. We have a break through the level with the Bank of England decision to remain on hold, but the price quickly retreated below the level after Carney said that, yeah, okay, we're on hold this month, but we're going to act next month, right? So that put the pair back under pressure. Um, there was a limited sense of risk appetite the next days that pushed the price back towards that 34.80. But honestly, guys, I do believe that any approach to 35 is still seen by the market as a selling opportunity, and that we should not expect the pound to recover above that level anytime soon. Okay. Anyway, and back to the short term. We have this low from last Friday around 31.30, which for me is the immediate support now. If we break below that level, I do believe that we have scope to extend its decline around to to 30.70, 30.80, and even lower down to 30.30, 30.20. The pair has been moving in a wide range in here, and we are at 31 historical lows, so we can see 50, 60 pips movements quite fast going on with not much in the way, okay? But the risk is clearly towards downside as long as the price remains below 33.20, right? That's the field of resistance. And of course, sentiment towards the pound is quite bearish. The OC has made something quite wild last night with both central banks acting, right? Pair has been developing in within an ascendant channel. It failed to break above it, but overall, the OC was bullish due to the rates differentials. Guy, while most economy have their rates close to zero or below zero even, and the fact is that in Australia, banks paid 1.75%, right? So the rate differential favored Aussie bulls. And all of a sudden, with the Reserve Bank of New Zealand and the Bank of Australia, we have the pair plummeted pretty much 100 pips over the past Asian session and breaking below the base of the channel. Uh, it's quite relevant, although I do believe that the line in the stand in here stand at 74.50, which, sorry, I know I changed charts a lot, which is the 38.2% retracement of this year rally, right? So as long as above that level, I do believe that downside risk is limited still. And now that I'm taking a look at the daily chart, seems that we have sort of a double roof in here. And of course, the neckline is quite below, but we can turn pretty low, but bearish if a pair breaks these levels. I'm still willing to buy against this level, to buy around this level with a tight stop rather than wait for a break and sell. I don't know. Let's see how things go on from here on. But overall, I do believe that this is the level to watch, okay? Uh, we have the 200 exponential moving average near the daily low around 74.85. So below that level, we may test that key Fibonacci support later today. I guess that if you want to look for a resistance in the short term, the 75.30 region, where the pair should complete a pullback to the broken trend line, would be the level to watch and the level to recover. To talk about a fake downward breakout by the end of the day, right? But if we don't quickly settle above 75.30 and rally, the risk seems to be towards the downside, right? And for the dollar Japanese yen, well, we have staged an impressive recovery after A1 elections, right? And menace us with fiscal and monetary stimulus for the upcoming July meeting or August maybe. Anyway, the market has already priced in. I believe that we discussed this already. The market has priced in some action coming from the Bank of Japan at this month meeting. Okay, so unless they trigger a big bazooka, market reaction could be inverse when they finally came out. Not to mention that if they stay on hold this month, the pair would probably plummet back to 100. Anyway, and for the shorter term and for this week, I'm not expecting much big market reactions in here. Mostly consolidative stage that we are seeing ever since stopping around 106.30. So the consolidative stage may extend and even advance further. I have my daily 100 moving average, okay, around 107.50 here. So that's a probable bullish target if we break above 106, this 180, which is the high, the pre-Brexit high, right? Those are my main resistance for today and the upcoming days. But I'm not seeing the pair breaking through this 100 moving average ahead of Bank of Japan. Okay, the Bank of Japan will hold the key. They need to do something really big to see the pair breaking through that level. Anyway, And the peer has been finding some buying interest around 105.25 these days. So that's my support. I would like to see a candle opening below that level, to see the pair reversing this upward momentum and moving lower. Approaches to this level could be nice intraday buys for some pips, but not much and not for long. Okay, but that's my main level. And the next one comes at 104.60, 104.40. So as long as above that level, I won't risk much of a sell, And uh, the other thing that I'm following, it's gold, right? We have a 6-week rally, mostly fresh year highs, double roof, and all of a sudden a weekly slump, right? As other markets' confidence somehow resume. And I believe that it's not market confidence. So we have stocks running higher and to fresh year highs, not because confidence has built up, but because of United Kingdom and uh, Bank of Japan promises of further easing. Now we have the Bank of New Zealand jumping into the easing party, and the Reserve Bank of Australia has been dovish. So pretty much most major central banks are willing to add liquidity to the market, right? And that is very welcome by stock traders. So mostly, I do believe that this retracement in gold has been some profit taking, right? Uh, and repositioning, guys. We are not so much not that scared that we cannot go into stocks when they start rallying big, right? Investors are taking a big risk for me in that case, but it's just my view, okay? Anyway, what I'm seeing in here is that the decline has been pretty much corrective, and we don't have much of a bearish signal of signs that the pair may continue. Gold may continue falling anytime soon. Um, I could say that this previous high is a few cents below the 38% retracement of this upward move, 1305. It's the region, right? The level to break, to see a more steeper decline in the commodity. In the meantime, I do believe that the risk remains towards the upside and that we may see some further gains up to the highs and up to 14. But mostly I'm expecting it to remain consolidating near the highs. I'm not seeing any good reason to see the pair plummeting, not even if we have a strong dollar. The main reason that why the gold can really fall is that we have clear signals coming from the Fed that they will act much sooner than expected. Okay, and the other thing I'm watching right now, okay, there we go. The euro is plummeting. Not sure what's going on, but I will check the news in a few. Um, and the other thing that I'm watching is oil prices, right? Sorry, it's taking long for a day. I do believe we have discussed along the fact that it has reached a sort of comfort zone, sorry, in between 45 and that 52. We have a slightly negative trend going on, but the commodity seems to have found the bottom around 45, and approaches to that level are attracting some intraday buying and speculative interest. So honestly, not betting much on a decline. Instead, it was saying if we break below this 44.40 level, which was this week low for me, the commodity can go down to 40 to 50 maybe, but I don't believe that we are going to see nothing below 40. And I do believe that declines below this 44, 45 region we will probably be temporal and speculative interest would rush to push it back higher. We have not bad news coming from the oil sector, not more than the usual ones. And uh, overall economies are picking up. Even China has grew during the second quarter much more than expected. No, not much more, but more than expected. So overall, I'm not expecting oil demand to all of a sudden shrink, and I'm expecting the commodity to remain on range, right? Okay, I believe that's it for today. Sorry, guys. Uh, uh, it's being a very cold winter in here. We are always always with a flu, always with sick these days around here. Everyone and all the family is sick. But anyway, here we are working with you and for you. Okay, that's it for today. Thank you and see you soon. Okay, bye bye.